Scott, in the be careful what you wish for department, you're looking at maybe that a rate cut wouldn't be so great for stocks after all.
That's right, and this is sort of the focus of a new note from UBS, and they kind of looked at the past two rate cut cycles in 2007 and 2001, and they found that the stock market did go up after that, but they call it a trap. And they said that once earnings growth for the S&P 500 went to 0%, which it did in both cases, that's when you saw a precipitous market drop. And when you think about it, earnings expectations are actually coming down for 2019. In fact, for the third quarter, we're now expecting a year-over-year decline in earnings growth, whereas a couple of weeks ago, we were still expecting a little bit of earnings growth in the third quarter. So I think the takeaway is don't necessarily assume that a rate cut is just a guaranteed boost for the stock market.
But on the other hand, too, there were variables in play in 2007. I mean, we had the huge debt bomb in subprime mortgages, and then in 2001, we also had the issue of 9/11. I mean, did they adjust for how that contributed to this?
Well, I think that's a good point. And what we have now to add on to that is, of course, trade issues, which could throw a whole nother wrinkle into this situation. But I still think the takeaway is the Fed is an important part of the market, but you don't necessarily want to look at the Fed on an island, right? There are other things to keep in mind, earnings, trade, things like that.